Inflation has become the financial headline of our time. Since 2020, we've all felt it at the gas pump and the grocery store. We are living through a period of higher global inflation than we've seen in over 4 decades, and this isn't going away. Inflation will remain a central theme heading through the end of this year and into 2025. Now, recent data shows that inflation might be cooling faster than expected. But most people misunderstand what inflation actually is. It's not just prices going up. The common mistake is to look at the price, but economists look at the rate. Inflation is technically the rate by which the price of goods and services increases. That distinction is critical. It focuses us on the process of how we measure the money required to buy things, and it gives us clues as to what's causing the inflation in the first place. So what is the most common cause? It's simple: an increase in the money supply. Think of it this way: if there is too much money chasing the exact same amount of goods and services, prices must go up. This applies directly to government spending. If a government spends more money on goods and services than it takes in, this imbalance increases demand. That demand, in turn, drives up prices for everyone. We just lived through a perfect real-world example of this. In March 2020, the U.S. government passed the CARES Act. This involved spending $2.2 trillion to curb the economic impact of the coronavirus. It was the largest rescue package in United States history. Just 1 year later, in March 2021, the government spent another $1.9 trillion on the American Rescue Plan. This distributed $1,400 to every American. It also sent extra funds to state and local governments and expanded unemployment benefits. The result of all this new money entering the economy was predictable. The Consumer Price Index, or CPI, increased to 8.5% in 2022. This was the largest annual increase since 1981. Of course, other factors contribute to inflation spikes at a global level. International conflicts, spikes in oil prices, and massive disruptions in global supply chains all play a role. But why does this matter to you, beyond the obvious? Inflation is a devaluation of money. It literally diminishes the purchasing power of your money, and therefore, it diminishes the value of your investments. For example, if you earn 5% from investments in stocks and bonds during a year with a 3% inflation rate, you only actually earn 2%. Increasing inflation rates mean that the money you invest today will be worth less tomorrow. The higher the inflation rate, the less power your money has. This impacts everything from housing to groceries. And yes, it absolutely impacts cryptocurrencies. If you are invested in, or even just interested in cryptocurrency, this inflation is both an opportunity and a massive challenge. Let's look at Bitcoin. Based on historical data, cryptocurrencies like Bitcoin have sometimes acted as hedges against inflation. The core reason for this lies in its design. Bitcoin has a finite supply of only 21 million coins. This built-in scarcity means it is, in theory, more protected or safeguarded against the pressures of high inflation rates. Think about it. The quantity of Bitcoin will always be limited and known. As a result, the creation of new, unmined Bitcoin is predictable. This is the exact opposite of a fiat currency, where a central bank can decide to print trillions of dollars, devaluing the money already in your pocket. But not all cryptocurrency is built the same as Bitcoin. Let's consider stablecoins. Stablecoins, unlike Bitcoin, peg their value to a more stable reference point. This is often a commodity or, more commonly, an actual fiat currency like the US dollar. This pegging makes a stablecoin far more predictable and less volatile than Bitcoin. It also remains free of any centralized financial model, like a bank. That being said, a stablecoin will have the same inflationary response profile as its underlying asset. If a stablecoin is pegged to the US dollar, it will inflate or deflate right alongside the dollar. But as a decentralized asset, stablecoins could provide a powerful way to store value against the inflation of a local currency. This is where the story gets really interesting. In 2022, the US inflation rate hit a 39-year high of 7%. That same year, Turkey hit an inflation rate of nearly 36%, and Argentina reached a staggering inflation rate of 54.8%. These massive spikes in inflation were, as we discussed, due to the unprecedented amount of money governments were printing in response to the global pandemic and other factors threatening their economic stability. This surplus of money chasing the same finite amount of goods and services inevitably devalued their respective currencies. In response, people in those countries seek capital appreciation for their money. They buy securities, real estate, and other assets that lock their money in for a period of time. But this strategy has a huge drawback. They lose liquidity. Enter stablecoins. In theory, stablecoins present a worthy investment opportunity if you want to secure your money's value against inflation while still maintaining liquidity. For example, let's say an investor or a group of investors in Argentina wanted to secure their value against that 54.8% inflation rate. They could, in theory, retain the value of their savings with a stablecoin like USDC, which is attached to the US dollar. This would secure the value of their investment and allow them to maintain liquidity, all outside their local inflating currency. Granted, this is a hypothetical, but this model opens up incredibly interesting possibilities for decentralized finance or DeFi investments in a truly global economy. Looking ahead to 2025, the consensus narrative is one of stabilization. Many economic experts anticipate that inflation rates will gradually cool down. We hear this from central banks, like the Federal Reserve in the United States, as they adjust monetary policies and tell the public they have the situation under control. But here is the so what factor, the part of the story that gets left out. Stabilize does not mean reverse. The purchasing power you lost at the grocery store over the last few years is, most likely, gone for good. The stated goal of the Federal Reserve is 2% inflation. This means your money is designed to lose value every single year, just at a slower and more predictable pace. This creates an entirely new problem. If the current level of volatility in traditional markets continues, and if inflation simply settles at a low and stable rate that still erodes your savings, people will begin to question the design of the system itself. This is the precise moment where decentralized assets shift from a risky speculation to a logical alternative. Investors, and more importantly, everyday people, will increasingly seek a refuge from inflation risks. They will look for assets that a government or central bank cannot devalue by simply deciding to print more of them. This brings us directly back to the Bitcoin thesis. Its core value proposition is not just digital gold. In this new environment, it's a digital life raft. It is an asset with a mathematically guaranteed scarcity, existing in a world of theoretically infinite money printing. This same logic also fuels the entire decentralized finance, or DeFi, ecosystem. DeFi is, at its core, a parallel financial system being built from the ground up. It is one that does not rely on the same banks and intermediaries who often benefit from the traditional inflationary model. Now, to be clear, the future is uncertain. This transition is not guaranteed, and the risks in crypto remain incredibly high. But the potential of cryptocurrency is now undeniable. It represents a fundamental movement towards creating a more accessible, transparent, and global economy. When you connect the dots, the picture becomes clear. We have persistent concerns about rising inflation, destroying personal savings. We have increasing instability and a growing distrust in the institutions of traditional finance. When you combine these two powerful forces, the adoption of DeFi as a possible hedge against inflation could skyrocket. And just as importantly, its adoption as a cross-border payment solution could redefine how money moves around the world. This is no longer just about investment or getting rich quick. This is about utility. It is about the people in Argentina or Turkey, as we discussed, finding a practical way to opt out of a failing monetary policy. So let's sum this all up. Inflation is a massive destabilizing challenge for the global economy. For crypto, it is a double-edged sword. It creates volatility, but it also provides the single most powerful and urgent use case for its existence. It is a unique opportunity, ripe with possibilities, that is forcing a global conversation about what money actually is and who should be allowed to control it. As we all learn to navigate these profound shifts in our modern economies, our advice here at Economics X is always the same. Stay informed, understand the systems at play, and keep your options open. So what do you think about inflation? Is it the number one driver for crypto adoption? What are your predictions for 2025? Let's keep this conversation going in the comments below.